Maybe you've asked yourself how to get started investing in real estate, or wondered what makes sense to buy a property that's a smart investment, while another one is a risk. The truth is, successful investors do not rely on gut instinct. They rely on numbers because the path is always in the math. And there's two formulas that have stood the test of time, the 1% rule and the 70% rule. And while they're harder and harder to meet, we're going to dig in and let's talk about what they mean. Whether you're dreaming about your first rental, exploring your first flip, or just curious how experienced investors decide if a deal makes sense, understanding these two rules is the perfect place to start. Now let's break down how they work, and more importantly, how they're playing out right now in the Austin, Round Rock, and Georgetown markets. The 1% rule is basically a quick litmus test for a rental property's viability. It says your monthly rent should equal 1% of the purchase price. So for example, if you buy a property that's $300,000, ideally you want about $3,000 per month in rent. Investors use this rule as a fast filter, a way to quickly evaluate the cash flow without diving into the full expense line. If a property clears that 1% mark, it's likely to perform well on paper. But here's what's happening in today's market. In 2025, Austin's rental landscape looks very different than just a few years ago. We're seeing an oversupply of rentals, partially caused by homes that didn't sell and owners who decided to hold them and rent them out rather than the loss that they would take selling them. Add in new apartments and developments, and the rental numbers are absolutely shifting. According to Realtor.com, rents across the Austin metro are down about 4% year over year, with the average rent sitting around $2,100 a month. That means 1% returns are increasingly rare, like unicorn level rare. For most investors here, gross rent to price ratios are closer to 0.8%. So that same $300,000 property that ideally should rent for $3,000, well, realistically, it's probably pulling in closer to $2,400 a month, if that. And once you factor in property taxes, insurance, maintenance, and vacancy, cash flow can get tight, maybe non-existent. So here's your takeaway. If you are analyzing rentals in Central Texas, sure, use the 1% rule as a starting point, but also understand that 0.8% or maybe even less is a new normal. I know that doesn't sound like the happiest of news, but here is the good news. Austin and the surrounding area still offer strong term fundamentals, job growth, steady migration, and appreciation over time. So while the short-term yield may not blow you away, the equity growth can be worth the patience if you feel committed to the Austin area market. And if you're serious about investing, make sure that you have a realtor who's doing enough business to have a pulse on the market, someone who has their feet on the ground that can help you spot opportunities both on and off the market. Because in this environment, the best deals are not sitting on Zillow. They're moving quietly behind the scenes. Now, if you're more drawn to the idea of flipping properties instead of holding rentals, the 70% rule is your new best friend. This formula has been around forever, and for good reason. It gives investors a clear ceiling on what they should pay for a property. So here's how it works. You should pay no more than 70% of the property's after repair value. ARV is what we call it. And that's once you subtract your repair costs. So the formula is this. ARV times 70% minus repair costs equals your minimum price point. For example, if a home's ARV is $400,000 and repairs are going to cost $60,000, your max purchase price should be $220,000, unless you know something about future appreciation. Now that 30% buffer is there for a reason. It builds in room for holding costs, closing costs, realtor fees, and profit margin. And with rising material costs and longer delays on market, that cushion matters more than ever. Now here's how we're seeing this play out locally. One of our sellers recently got an offer from one of those iBuyers. It's a large investor group that makes quick cash offers. They offered him $480,000 for a home that we are preparing to list for $650,000. So why such a big gap? Because investors live and die by their numbers. If they follow the 70% rule and factor in even the minimal repairs, let's say $5,000, they would cap the purchase price around $450,000. And that's the safety margin. So from an investor's perspective, that $480,000 was actually pretty generous, but still far, far short from the retail value. Now the 70% rule can still work in today's market, especially if the property is distressed, outdated, or owned for several decades. Sometimes a seller just wants out. They don't want to test the traditional market, or maybe their family or heirs just want to be done with the investment. And so that's when investors can step in and create a win-win. But, and this is a big one, even a beautifully renovated flip can sit on the market right now. For example, and these are real examples that we've seen recently, if corners were cut to save money towards the end, buyers will walk away. If the home backs to a busy street or commercial property, it's less desirable. If it's the nicest home in the neighborhood where comps don't support the price and it is way off, buyers in today's market are more cautious, and they're also more price sensitive. They are savvy and they notice the details. They're paying attention to the layout, the lot, the location, and not just those beautiful shiny floors. So for flippers, discipline is everything. Know your numbers, build in your margin, and don't let emotion creep into the math. And again, this is where working with a realtor who's deeply active in the market becomes critical. You need someone who's walking homes every day, who's talking to buyers and seeing what they like and what they don't like, who knows the properties buyers are responding to and hearing what's turning them off. Because the difference between a profitable flip and a long, expensive hold often comes down to the insight that you can't just get from a spreadsheet. Here's the big picture. Both of these formulas, the 1% rule and the 70% rule, are fantastic starting points. But they're also not the gospel. But they are nice guardrails to help you keep from overpaying, overleveraging, or overpromising. If you're serious about investing in the Austin area, Travis, or Williamson County markets, then please keep these 3 principles front and center. Run conservative numbers. Assume rent and resale values on the lower end. Leave room for surprises, because there will always be surprises. And know your market. What works in Dallas or Phoenix will not work here. The investors who win right now are the ones who stay disciplined, flexible, and data-driven. If you're thinking about investing or just wondering how these numbers would play out on a specific property, just reach out. Our team is doing data analysis every week, and we know where the opportunities are, what the real numbers look like, and how to help you find the right fit. Because the real truth is, formulas are great, but relationships and local insight are what uncovers the best deals. And that's where we come in.